morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're speaking a little bit about financial results from two producers of what might be considered staples of the Trinbagonian diet. We're speaking, of course, about the results of National Flour Mills, or NFM, as well as Angostura Holdings Limited. Now, both groups would have reported reduced revenues, but varying fortunes in terms of the overall impact on profitability. So let's take a look at what the both groups would have reported and what investors might expect in the coming months ahead. Turning firstly to National Flour Mills, or NFM, well, the group would have reported a 17 cents earnings per share figure at the half year mark of 2024, representing a 29% increase from the 13 cents per share reported in that prior comparable period of 2023. Revenues were actually down 12.4% from 289.2 million to just about 253 odd million. And that was as a result of a conscious decision on the company, or by the company rather, to reduce the prices of some of their goods. So revenues were lower, despite, in fact, of a roughly 5% increase in sales volumes, according to the company. Gross profits falling a less than proportionate 3% from 73 million to 71 million. Overall operating profit declined from 9.1 odd percent from 29 to 26.5 million. However, lower finance costs contributed to a 3% overall increase in profit before taxes, from 25.3 to 26 million, with profit for the period increasing on account of a lower effective tax rate from 15.9 million to 20.5 million. Now, when we take a look at the revenue story for NFM, we would have seen that post-COVID, there would have been consecutive periods of revenue increases, most notably in that half-year period of 2023. And this would really have been in tandem with the volatility attributable to grain prices at the global commodity market level. With that correction, that correction or revision to the mean in terms of commodity prices, wheat commodity prices anyway, there would have been a positive pass-through effect to consumers with those ultimate reductions in prices by NFM to its retail population, and that would have resulted in that 12.4% or the decrease. Of course, looking at the trend historically since post-COVID, or from that COVID-affected year coming forward, we still see that there has been, notwithstanding that half-year 2023 abnormal degree of revenue, a fairly positive and upward trend for NFM in terms of revenue over those few comparable periods. Now, looking at the profitability margins of NFM, well, they have been improving relatively steadily. And at the half-year mark of 2024, profit before tax margin in that purplish segment, for example, was at 10.3%, an improvement from the 8.7% recorded in that prior comparable period, meaning that despite those revenue decreases, NFM is doing a better job at converting every dollar of revenue into profits, which is, of course, positive news for investors. Even at the operating or gross profit margin level in that green segment, we can see that would have improved from 25.3% to 28%, which is reflective of improving cost of sales or reducing cost of sales relative to revenues over time, again, coming with that correction in grain prices at the global level. So at a price of $1.80, NFM is trading at a price to earnings ratio of 5.3 times, which is considerably below the sector average of 10.1 times, but offers investors a dividend yield of just around 1.7% at the moment, which is considerably below also the sector average of about 3.9%. So with those reduced revenues in mind, however, looking at that improved margin, but the below average dividend yield, Bourse is going to maintain a market weight ratio on NFM for the time being. Turning very quickly to Angostura Holdings Limited, well, the group would have reporting an earnings per share figure of 32 cents per share, which is a roughly 16% decline from its 38 cents recorded in the prior comparable period. Revenues also for Angostura Holdings were down just about 3.2% from 474 odd million to just under that $459 million mark. Gross profits down a more than proportionate 11.6% from 254 to 225 million on account of what, according to the group, might have been one of our inventory revaluations. Ultimately, profits for the period down around 15% from 77.8 million to 66.2 million. Now, the revenue trend for Angostura has just for fiscal 2024 turned a bit negative, of course, at the half-year mark, despite multiple years in recent comparable years of positive revenue growth. We can see that at 3.2% may represent an anomaly in this first 6 months of 2024, and we of course look forward, and investors look forward to see if Angostura can turn around this revenue trend in the remaining few months of the year. From a profitability perspective and an operating efficiency perspective, not too much in terms of change, but of course a little bit lower in terms of profitability margins. Gross profit margin, for example, falling from 53.7% to 49.1%. Again, some of those inventory revaluations perhaps having an impact on that particular margin. Ultimately, profit after tax margin falling to the lower end of where it would or where it has been over the past 4 comparable periods at 14.4%, reaching a high of 16.4%, most notably in that recent half-year 2023 period. So, of course, some work to do for Angostura in terms of its profitability margins going forward. Of course, the company has taken several initiatives in its 200th anniversary year in terms of new product launches, among other factors, which hopefully should turn around some of these metrics. So when we take a look at AHL historically compared to its own multiples, we can see that as at the halfway mark of 2023, it was trading at a fairly lofty price earnings ratio of 30.3 times. That has since moderated to around 25 times a price earnings ratio. However, still a little bit above where it was trading around that COVID period of around 21 odd times in terms of price earnings ratio, meaning investors are still paying a little bit more per dollar of earnings generated for AHL stock relative to what they would have paid around that particularly COVID period. But that valuation is getting a little bit better at this particular point in time. So at a price of $17, again, AHL is trading at that 25 times price earnings ratio, well above the sector average of 10.1 times, and still a little bit above where it would have historically traded at around that 20 to 21 times level, and offers investors a dividend yield of 2.2%, again below that sector average of 3.9%. So with that lower revenue in mind, the reduced margins, at least in the short term, and those relatively high valuations, Bourse is maintaining an underweight on Angostura Holdings Limited for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773. Email us at invest@boursefinancial.com. And of course, you can check out all of our research at bourseinvestment.com for free on our website, and catch this article in today's business section of the Guardian newspaper. And stay tuned with us next week as we go through that pre-budget wrap in anticipation of the reading of the fiscal 2024-2025 budget. So enjoy Republic Day, stay safe, happy investing, and we'll see you again on the Bourse Report.